What can be better than the beginning of this insightful day than with a conversation about paradigm shifts and digital revolutions? We stand today at the precipice of change, one where AI learns to count money, and blockchain is no longer a phrase known just to technologists. We delve into the heart of innovation, exploring the profound disruptions set to redefine the financial services landscape. Bringing together the brightest minds, this panel discussion on the revolutionary technologies set to change financial services is set to uncover the secrets of these game-changing technologies. Ladies and gentlemen, put your hands together to welcome our moderator, Ms. Monica VanHorn, who is the director and founder of Catalyst, and our panelists, Mr. Prashant K. Dhingra, who is the chief Data Science and Technology Officer at Dataknobs, Chris McCraley, founder and president of SRS Platinum Incorporated, Michelle Gordon, who is the CFO of GrowOut Retreats, and Sujan Sanku, Chief Operating Officer of 99 InfoSystems, Inc. The spotlight is yours.
Thank you. Check, 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 check. Everybody hear me okay? Okay, well, great. Thank you so much for this very warm welcome. We're really excited to be here. As just mentioned, I'm Monica VanHorn. I'm founder of content marketing and PR boutique Catalyst Communications in New York. We have been supporting the financial services, technology, and compliance sectors. I can't believe it's already going on 20 years. I have seen several business cycles that have been particularly challenging for all three of these verticals, including, currently, obviously, we're in the midst of a banking crisis. Transformative technologies in the financial industry, of course, they run the gamut, as mentioned. Blockchain, crypto, yes. Quant trading, machine learning, AI-powered risk management tools that proactively flag risk while streamlining, monitoring, and reporting. While we won't have time to touch on all of these technologies, we will do our best to reserve some time for your anticipated questions. But why are we here? I think to understand some of these issues in context, we'll take a little quick walk through history. Just a quick one, I promise. In the 1400s, the Medici family rose to prominence in northern Italy, the birthplace of modern banking. In fact, the word bank comes from the Italian word banco, which means bench, a reference to the benches on which merchants and bankers would transact business face-to-face between counterparties. It was such a different world then, because here we are now, face-to-face, establishing some form of relationship, hopefully closer, as we get to know each other. Needless to say, the relationship between proximity and trust building in banking has changed a little bit in the intervening centuries. As a case in point, an article last month in the Wall Street Journal describes a tiny island called Palau. I wonder if any of you saw this in the journal. It offers residency for just $248, enabling traders to access banned crypto trading platforms through a backdoor without even having to set foot on the island. This could be great advantage for cross-border crypto trading if we could just figure out now exactly where Palau is. How far we've come since the days of face-to-face banking on benches. The issues of proximity and risk has existed in the financial industry for centuries, with constantly changing rules, a growing number of intermediaries and supervisory checkpoints that has supported the expansion of global markets. As geographic borders continue to erode and banks do business further afield, the cost of conducting a compliant business are significant and rising. Failing to adapt to changing rules, tools, and business demands can lead to reputational damage, loss of licensing, loss of profitability, of course, and even closure. So I wonder why we are here discussing yet another banking crisis, when already, fresh from the 2022 crypto crash that culminated in the collapse of FTX, and lingering turmoil today at Binance, among others, the banking industry is still regrouping from the implosions of SVB, Signature, First Republic, and Credit Suisse, and others. But what I was wondering is why were they caught by surprise yet again? Haven't we learned from prior market runs followed by spectacular crashes fueled by high-risk trading and investment? To paraphrase an adage, history itself does not repeat itself, but it often echoes. I think someone said that was Mark Twain, but then another friend of mine said it was somebody else. But it is a saying, and it's apt. History doesn't repeat itself, but it often echoes. It really wasn't that long ago since the subprime mortgage crisis of 2008. The very same year, Bernie Madoff was charged with the financial industry's biggest global Ponzi scheme to date. In my mind, it would be interesting to hear from the regulators that whistleblower Harry Markopolos urged years in a row to do something about Madoff. Would they say preventive measures that leverage the institutional memory of our regulatory apparatus have since been put in place? What exactly is the regulatory apparatus for sharing the institutional knowledge presumably forged in the centuries since we transacted business on benches? A recent article, After the Reports and Recriminations, What's Left to Learn About the 2023 Bank Failures, written by my very good friend Jeff Cutler, editor at the Global Association of Risk Professionals. That article shares relevant observations from Augustin Karstens, the general manager of the Bank for International Settlements. Karstens said at a June European Banking Federation Summit that the current bank crisis was caused by the failure of directors and senior managers to fulfill their responsibilities, business models that were poor, risk management procedures woefully inadequate, and governance lacking. Karstens further said that for regulators to do their jobs effectively, they need operational independence, a more forward-looking culture, and better technology tools to enhance their productivity. For its part, the US Government Accountability Office and industry regulators concede they moved too slowly to address the banking problems, and some problems that were identified, once again, years ago. Fed Vice Chair for Supervision Michael Barr said supervisors didn't fully appreciate SVB's vulnerability, this is a direct quote, as it grew in size and complexity, and when they did find risk, they didn't respond quickly enough. Meanwhile, the US rating agencies were also out of step with the bank's real risk profiles. S&P Global Ratings and Moody's both gave SVB and Signature satisfactory ratings at the time of their collapse and within weeks of the enforcement actions. The FDIC took action to address the problems at Signature, but did not downgrade the bank until the day before it failed. So no question about the need for a more forward-looking culture and better technology so these agencies can move more quickly. But hearkening Karstens' comments, in what ways does the need for operational independence impact regulators' jobs? An ongoing GAO inquiry into the supervisory lapses could answer these and other questions regarding the objectivity of bank self-assessments, as well as the timeliness of bank supervisory efforts. But other factors led to today's industry instability. In 2019, Congress enacted the Economic Growth, Regulatory Relief, and Consumer Protection Act, rolling back key Dodd-Frank provisions that resulted in many regional and mid-sized banks receiving lighter oversight than large banks and loosening what's called the Volcker Rule, for those of you who don't know, that prohibited certain banking entities from engaging in prop trading, proprietary trading, or investing in hedge funds or private equity funds. So this rollback really provided a window of opportunity that enabled banks and traders to take on more risk. The combination of reduced regulatory oversight, increased inflationary pressures, and the promise of blockchain technology drove crypto markets into the speculative frenzy that we all saw before the sell-off. So again, I ask, given the echoes throughout history, why weren't regulators already on high alert? In the run-up to the 2008 market crisis, BIS advisor Hyung Song Shin, I hope I'm pronouncing that correctly, warned that floods of speculative money chasing mortgage securities should lay at least part of the blame on the emergence of a shadow banking system. Today, that system includes hedge funds and a relatively new crop of online-only so-called neobanks that took on risk in exchange for wildly profitable trading and investment opportunities backed by brilliant quant formulas and the world's most powerful high-speed trading systems. If we can make profits at warp speed on high-frequency trading desks, why on earth does it take regulators months or years to take preventive action? Did they anticipate Or did they follow the money trail when, according to a Reuters exclusive, Russian traders had the incredible prescience to move billions of dollars out of the UAE just weeks before the Terra Luna collapses that triggered last year's crypto market crash? Far from the benches of Italy, today we conduct business with people we may never even meet across the borders of countries that might not even exist. We still hear the echoes of countless crashes and crises over the years, and who can predict the next black swan? Inevitably, there will be future crises, and each one will differ from the ones before it. So to paraphrase the adage, history doesn't repeat itself, but it certainly does echo, and we all would be wise to use all of our senses to heed the observable patterns. Okay, with that, that's a lot to unpack with my friends here and fellow panelists. And we are going to go ahead and do that. As I said, hopefully time will allow us to take a few questions. And with that, I will go ahead and start with a question, speaking of the shadow banking industry. Sujan, if I can toss this one to you. As I mentioned before, a key provision of Dodd-Frank that was rolled back in 2019 resulted in a loosening of some of the rules that allowed some of these banking entities to take on more risk within their right to certainly to do so. Two-part question, actually. First, could you give us an overview of the shadow banking industry, sort of the neo-banking sector of it? And second, is there a link, do you think, between the explosion of risky so-called shadow banking and the trading hyperactivity that led us to today's banking turmoil?
Okay, thank you for that question. I hope all of you were following that long introduction. Good morning. So, in the US, obviously, there's the FDIC. In Europe, there's the DGS. I think they make sure that whatever you deposit in the bank to a certain level is insured. I think most countries, either the Fed or a Reserve Bank, maintains these rules. They keep regular banks on a very short leash, but neobanks, especially if they have back offices managed by fintech, they are usually not governed or ranked or even assessed by Camel or any other risk mitigating ranking system. So they pretty much have a pass-through, and their business model is very different from incumbent banks, obviously. It's not based on, loans and investing what we deposit in the bank. Their business model is usually take a piece of the remittance or your debit payment. I think the easiest example for this is, I think Revolut, most of us might know. They've been, I think EU just gave them proper banking status, so they're actually a bank now. But if you've been following the news, they keep fumbling. There was a huge issue of quite a few $1 million that they paid out from their own revenue. So if there's not enough regulatory, red tape, obviously we don't really want the red tape, but the red tape is there to protect not the creditors, but us, the users, and then the commercial entities, like the corporations that keep their money in the banks. So I think going forward, even these neobanks and internet banks, there's the convenience factor, but since we can't track what's happening, we don't know the flow of the money, where is it going, who is it coming from, there's a huge risk of money laundering, there's a huge risk of tax evasion, and I think the underlying factor is that it can't be tracked. Obviously, that's why it's called shadow banking. So people on the wrong side of the law, or I think even us, nobody really likes to pay tax. I'm guessing we're all finance people. We want to avoid it as much as possible. So like you mentioned, there are quite a few of these tax haven islands or islands that are not too regulated. So they try to take it out, convert it into something that's less traceable in these obscure islands, and then carry it in different forms. Maybe it could be like gold or in other things like cryptocurrency. So I think it's a huge risk, but I don't see in the near future any legitimate way to avoid this risk. There is no country that has come up with a proper solution. So I think, obviously, we need a solution, but I don't think there is at the moment. So if there are any regulators in the room, please come to me. I would be interested in discussing whether there is a solution to this problem.
Yeah, well, the EU has just introduced their MICA proposal, and they are a little bit, ahead of us here in the U.S. Of course, it's still early goings, but it'll be interesting to see how that shapes up, at least on that side of the pond.
Yes, I definitely agree. So the EU usually is ahead of the US in many things, sustainability, banking, other things. But if they're ahead, they could also make mistakes because they come down with a hard foot, rather stringent rules. Like by 2030 or 2035, they said like no gasoline cars in UK or something. Okay, they're not technically part of the EU, but EU have this very strong-headed approach, and sometimes that can hinder progress. So I would take it with a pinch of salt. I mean, they look like they're going in the right direction, but I'm not so convinced that it's going to benefit us, the users of these banking services.
It's interesting. It reminds me of Formula One. Am I the only one who likes Formula One? Some of the drivers intentionally lay back until just the last minute. They can take some of the, what do they call that, overspeed or something, so that they overtake on the very last minute. So maybe we're intentionally laying back on the regulatory framework. Were you about to share anything, any of the other panelists on this point? David?
I think with the neo-banking, it gives a lot of flexibility that with like explosion of mobile usage and focus on customer experience. So neobanks that focus on mobile, digital, and customer experience will probably do well. There's a difference between neo-banking and shadow banking. Shadow banking is something which is avoiding compliance, which is avoiding the rules. So that should be, that should not happen, and compliance check should happen on shadow banking. But we'll see, I think neo-banking will probably increase because more and more customers are not going to branches. And with the focus on digital experience, they can benefit more, and neo-banking cost less. So we'll see increased adoption of neo-banking.
Yes, let me not suggest that we throw the baby out with the bathwater on the online banks. Not suggesting that at all. There is a sort of shadowy subsector of those that are allowing some of the illicit, type of activities that we mentioned before. But that's an excellent point. Thank you, Prashant.
We also have a tremendous backlog when it comes to what regulators impose on the banking system. So when we look for basically to do what we want to do, whether we are slightly shadowy, totally shadowy, or not shadowy at all, intentionally not so, we have this backlog.
Yeah,
They put it overhead, and that sometimes causes companies to reshift their priorities to meet regulatory demands rather than do business, right? So when you're in that position, you have a hard choice. You have money to spend here, you have money to build business, you need to sustain your business. Otherwise, you'll go out of business very quickly if you don't do what the regulators want. So we have to have this delicate balance, and we want to try to maintain some kind of integrity that you cannot maintain when you have a reputational flaw and hit. So it's a big problem.
right. This is all true. Well, speaking of regulations, and again, we really did want to try and focus a lot of our content knowing that we were combining Money 2.0 with the law audience among us. We are looking more closely at some of the regulatory compliance issues. And on that front, in the US markets, of course, we're free markets, we're open markets, we encourage innovation. And so there certainly is an argument to be made, and there's an argument that is often made, that some of the regulatory stance on innovation is to make sure not to curtail it. But in this regard, I will toss the next question, Michelle, to you, my friend. And that question regards cybersecurity risks, tips, and tools. I wonder, has the US's historic lack of regulatory prescribed approach to cybersecurity, meaning the understanding that a one-size-fits-all approach to cybersecurity wouldn't really be feasible, but has that lack of a prescribed approach to cybersecurity left our markets vulnerable? And more broadly, what are some of the latest Web3, cyber, and crypto threats, and how can companies leverage technology to address some of them?
Thank you, Monica. Great question. I definitely think we are vulnerable. We're vulnerable because we're human. And What do we do when we're scared? It's fight, flight, or freeze. Well, we froze. We didn't do anything. We didn't act. And so I think the big thing is act. What are you going to do? Some of the same issues that we see in crypto are the same issues that we've had in the past, with the same scams being seen, Ponzi schemes, the romance scams. They're all the same. The difference is with crypto is you do not have that intermediary, the bank, to act as a backstop. Without that backstop, you're going to be seeing lots of losses. So what can you do? Well, number one, do you have somebody on your team that is knowledgeable in cybersecurity? If you don't, maybe you should look to get somebody on that team, on your governance committee. Have a cybersecurity audit done. Where are your risks? If you don't know where your risks are, you can't do anything about them. So knowledge is power. Inform yourself. Inform your team. Just because you might have policies and procedures around cybersecurity doesn't mean everybody's following them. It's a part of your onboarding process. Do you remind people at weekly meetings, are there consequences if they are not followed? Because there is consequences to your business. There's consequences with regards to insurance. Cybersecurity used to be this, insurance used to be this checkbox that you just checked off, sure, I'll take it. Now it's not. It's a huge form that you got to go through. I don't even understand half the questions on there. You need a specialist just to kind of help you make your way through it. So insurance is demanding that you become knowledgeable on it and that you do something about it. Your investors are demanding that you do something about it. So act, get informed, add somebody to your team that is informed about it, and act.
Make sure there are no shadows
Yes.
where people can hide. Okay, excellent.
Sorry, Monica, can I just add that there are things out there that you can do. So there's Iris Collective, which is trying to make people more knowledgeable and safe around Web3. So go online, check it out. It's a community, as well as a company I work with. So you got to do a plug for that one.
Yeah.
Dragon Scale is working on Web3 security. So definitely go and check those out.
Perfect.
Can I ask the audience a quick question?
Please.
How many of you have crypto wallets? Just raise your hand. How many of you are net positive? Ooh. How many of you are confident that what's in your wallet is going to stay there? Oh, wow. Okay, so I'm an early adopter, like 2008-ish. So obviously it like boomed beyond anything I imagined. I only bought in because one of my friends spent $50. Comp science majors, obviously new thing. Wasn't a big deal, but as a student, I guess that's a lot. So it did become like I can buy a ship level, but I never took it out. Now it's obviously worth much less. But there's an issue. So I live in Japan. So when you try to take crypto out, there's taxes involved. I think US, there's capital gains, other kind of taxes that are levied on it. So each country has a different way of dealing with these, because until recently, there wasn't any proper legal precedence of dealing with this. So it was good for a while. Everyone was happy, it's untraceable, no taxes involved. It's basically just money that just came out of nowhere. Just because it's blockchain, it doesn't mean it's unhackable. Everything that people have said, just because it's blockchain, it doesn't mean it's unhackable. Everything that people have said you cannot hack has been hacked at some point. So other fields to share data, medical, finance, every other field I think is trying to use it in other fields to share data, medical, finance, every other field I think is adopting it. But the problem with there's no trust anymore. So it's not even cybersecurity. I think the biggest issue is that, so there's no trust anymore. So it's not even cybersecurity. I think the biggest issue is that the general population doesn't trust the technology because of the first iteration being so scammy. I think that's how I feel, at least.
And that's one of the vulnerabilities that we're seeing. Rug pulls are a classic scam we see in Web3. And not only rug pulls, and we were saying, did you get a call from Orchard? And we were saying, did you get a call from Orchard? I said, yeah, I did. It was like, I didn't feel funny. I said, yeah, they were calling and the address didn't match, where they're calling from. They're asking for money very quickly, and it's like, well, they sound good and all that. It's like, oh my gosh.
Yes.
But your mind is trained
Yes.
that it's, oh, this is a scam. It's an instant scam. That's good. Our mind needs to be trained that way. Because when we're all in, when we're in a corporation, we're like in a castle wall. Now, the castle used to have a moat and very deep waters around it with very hungry alligators, I hope. Now that castle has to have the door open to allow people in. But if we don't know what we're going to protect, we have no choice what to protect. We have to simply protect everything. Firewalls are not good enough. Not even close. Because where your big vulnerability comes in, if you'll hear anything I say, it'll be a lot of vulnerability talk. It is your third party comes in that door and out of the door and exposes you to all these kind of things in cybersecurity anyhow. I have major clients. These are the major high-frequency trader leaders. They deal with money, near money, and make up money all the time because they bundle things together, right? So what you have here is an instant target that's constantly changing, and you have to be able to protect that target. Is there any right way? No. Is there any way? No. We don't know enough about any of this, so that what we're tracing is depending on data that's out of date, the periodicity is not there, and what you need to do is have something. I know we're going to go to talk about AI and algorithms and other human models, and we're doing the best we can. What we need to do, what do we need to protect, plus everything else, because if we don't protect something, that becomes a target, then we move over to say, okay, how do we protect this reasonably? Fortunately, we can seize on a lot of AI tools, we can seize on a lot of models, and we can seize on a lot of things that we've done, even in the shadow banking, that, when there's money, there's motivation. When there's motivation, we get innovation. You don't want to block that, and there's that balance we talked about at the beginning.
Mm-hmm.
Right?
Absolutely. Those are excellent points. And I think also a really good segue to try and putting AI, we're all hearing about AI, this ChatGPT that just exploded this past year. So as long as we're talking about financial technologies, regulatory risk and compliance, I'm going to toss this one to you, Prashant, because you have written books on the subject. You have contributed to a lot of notable research on this subject. So I would like to pose to you the question regarding the EU's draft AI rules that were just not long ago announced. Again, I have to say, I'm sorry to say, they're the first to put this sort of framework on AI rules out to the world to consider. And this includes bans on real-time biometric surveillance in public spaces and so-called predictive policing systems, which analyze prior criminal behavior and other data to predict illegal activity. Curious how you think AI will increasingly be used in financial services, over sort of what time frame in realistic, practical terms. And is there really, am I just missing, what is the downside to predictive policing? It sounds good to me.
Yeah, so I will cover this question and I will come back to the cybersecurity one also. So anyone heard about the Belmont report? Belmont report was launched in 1979 when a lot of research was done on behavior science as well as biomedical science. So it has three takeaways: that when we do research on human, we should do it for human benefit. We should do it in a respectful manner. That means humans should know that they are part of this research. And the third point was that it should not obstruct the justice. So people should not be put into some bucket in an unjustifiable manner. It has three key takeaways. So when we look into risk of AI, if we simply first adopt the three takeaways from Belmont report, then we can apply AI in a good way. For example, if you are applying AI to predict that there will be an attack on a school, probably AI is a good thing to apply to determine and monitor the social media. But if you are trying to apply AI to determine somebody will be a cause of trouble and you are trying to monitor them aggressively or you want to arrest them, then AI is not good because there is no evidence and AI should not be used there. So depending upon the use case, one need to think through how AI should be designed, for which use case, how it is designed, how it is deployed, and it needs to be continuously monitored. And then we need to ensure that 3 takeaways for Bellman reports are applied clearly. So if AI is used to help human, for example, if we are using AI to identify what are the risks of cybersecurity, or if we are using AI to create some phishing emails so that we can test our cybersecurity, then AI is good because it is done for the benefit for human. It is done for the protection of human. If we are using AI where we are making it obvious that how human data is collected, and we are following the law that if somebody says, I want to be forgotten, we are forgetting that human and we are removing their data, then it is the second principle that we are AI is respecting and technology is respecting the human. And third is like AI should not be doing injustice. So this comes to the predictive policing. If we are giving loan to people and AI somehow thinks like certain zip code or certain demographic has low potential to give it back, then it is a bad use of AI. That's where AI should not be making judgment about people. But at the same time, where we want to identify risk, where we want to identify like what kind of a personal product or investment can be made for people, that's where AI can be hugely successful. So we need to see the both side of the story. AI is powerful that human can't monitor so many variables together. AI can help us do that. So AI, it can help us handle the complexity. We should use it there. But because it handles the complexity, it can also, its decisions are based upon historical factors. So one should not be making decisions which impact human life. So that's where predictive policing should not happen.
Is it almost wanting to avoid a sort of a profiling?
Yeah.
Is that?
Yeah, one should avoid profiling, and specifically in those scenarios where it impacts how people will pay the loan or who should be given the loan. So those are the areas one should avoid it, where it increase the discrepancies between how humans are treated. It should be avoided.
Understood. I love that nuance. Thank you so much. Well, we'll spend just a minute here on our second to last question to the panel on something important that's happening in the industry.
One moment. Could I quickly play? I know that we're short on time, but kind of like a devil's advocate.
Yep.
So how many of you have watched Minority Report? Oh, good. So that's basically predictive. They would predict and arrest someone, right? In finance, most of you in finance have used some kind of predictive forecasting model. So honestly, I think AI is just an extension of this. And it's just a little bit more hands-free. Obviously, there's human in the loop for most of this AI because we need someone to hold the reins. But it works as of now. So ethically, there's a different argument. I'm not going to go into that. We don't have time. But I think if it reduces, like you said, the 3 points, if it reduces the workload of humans, I think we should use it and adopt it as much as possible, even though there are risks associated with that. So I just wanted to throw that in there.
Sure. Excellent. Excellent point, and thank you. Okay, so as I said, just a second, a little minute we'll spend here on shortened settlement cycles. But for those of you who may not know, on June 20th of this year, SEC announced a T+1 settlement cycle that will be effective May 28th of next year, unless anything changes. In 1999, we had T+3, which moved to T+2 in 2017. So we've kind of been through this contracted cycle of transaction settlement. Is this a non-event, Chris?
It's not a non-event. Nothing that changes anything how you manage money is a non-event. It impacts every part of the stack. When you talk about technology, it affects and impacts directly every part of every component of every person that works inside, around, and outside financial systems. You're going to be happy, unhappy, going to be all of those. Because these settlement cycles, when they shorten it, you're going to be interrupted as far as how you interact. Because your expectations are going to change. Now you're going to have, just like you do now, a portfolio of when something is, when you're going to pay for it, when you're going to clear for it, when you're going to have the cash available or the equivalent securities available, right? You don't have that, and if your broker and your agent doesn't have it, you're out of luck. You're not in it, and you may have just lost a great opportunity. So therefore, it's a very, very, and I want to correct and clarify something that was a statement was made before. The intention is to meet that date. The intention is to start that date. What the American regulators do, and yes, I'm going to differentiate Americans and Europeans. What I love about Europeans is the discretion. When I do an ISO 22301, 313, 27,000, all the numbers, implementation, I love that it's clear, crisp, and has definition. You have the context. Start with the context. You know what you're dealing with, and you know where you're coming from. In the American regulation, which I've dealt with FFIEC and all over, it's deliberately squishy, and I'm going to use that word. Why? Because we're moving it. We don't want to interrupt the innovation. We want to test it, fine-tune it, and get that down to something that works, not perfectly, because we have all these companies change, you know, all these programs, these interactions. We also have cybersecurity to worry about every micromillisecond, excuse me, I know it's close, of every day. And it's a reality. So anytime you institute change, and you open change management, you're instituting risk. Anytime you institute risk, you create a target. Anytime you create a target, you become something that is open to abuse. And when abuse comes in money, especially in transactional speed, frequency, that big time. We talked about it all over this panel already. So when we talk about a non-event, no. We talk about trying to have things that are going to make our lives easily. Sorry, it's more complicated. AI is not going to solve anything because we can't test it yet. We need to create tools to test these things. That's why we need to be back to the humans. How do we think? How do we breathe? How do we want to interact? Is anyone asking these questions? I don't know about that. You need to get to the people in the process. That happened before the technology. If you don't do that, you're not going to basically say, what do I want to really protect? Knowing that we have to protect everything else. Remember the fortress wall, the deep moat, the concrete shards, and healthcare. But you need to correct to accomplish those things, to know where to start, because there's no good way to start. But you have to make sure that you're sustainable.
Excellent.
I was going to agree with that, the people aspect of it. And I think that when you look at a problem, it's more than one person's problem.
Right.
It's more than a department. You know, you need to include everybody in that. How is it going to affect everyone? What role does each person play? And who is accountable?
And their competency to
Yeah,
understand.
definitely competency to understand. Hugely important.
Excellent. Well, okay, so in the interest of staying on track, those were excellent observations, and thank you all. Last question here. Given these and other developments that we've talked about and the various tech trends we've touched on, compliance has gone from a nice to have to something that is just essential in business today. We all know that. But anyone, I guess we don't need to hear from all of us, but Prashant, maybe you want to offer what your view is on how companies can survive, even thrive, by leveraging some of the technology that we talked about today, and then we'll have closing comments.
Yeah, so first of all, I agree that people and processes are very important. Technology is there to assist. And sometimes we build trust over a period of time. So I give this analogy, like if you go on an airport and if a dog sniffs that, okay, whose bag should be checked? We do not question dog that, okay, why did you pick my bag? But if the same camera or something, and people will question why my bag was picked for checking, etc. The reason being is that over a period of time, we have trusted that when dogs sniff, there is a reason, and then that bag should be checked. With AI also, as Chris mentioned, it's not fully tested. And there are areas where AI is doing well, there are areas where it is not doing well, and one need to think through in which scenario it works, in which scenario it doesn't work. And so companies need to design the technology and determine where it can automatically do the job, and it can do the, whether it is auditing or whether it is risk checking, like ensure that wherever it is deployed in a unbiased manner. And then after deployment also, we need to monitor it continuously, because at the end of the day, it is technology, people and processes need to be there around it to make effective use of it.
Fantastic, thank you.
I was going to say, I think that's really good.
1
And I
minute.
think that the important thing is creating safe spaces in your workplace to test those things out.
Yes.
Because if people don't get to try it and test it in a safe environment where it's okay to fail,
Yes.
like you want to test it, you want them to fail, you want to know what those limitations are. I think it's hugely important.
Yes. Yeah, absolutely. Like these things need to be tested, and experimentation is key. And after experimentation, one can determine which set of condition lead to success, which set of condition doesn't lead to success.
Right, and we don't want to test merely to check the box, right?
Yeah.
We want to test to create a control. That's a control on all those people and all those machines that are doing all that learning and adjusting, so that we can say, is this real or is this not real, right? Because otherwise we fall into the not real that looks pretty real.
Thank you, panelists. May I just say one more thing in closing? It isn't entirely off track, but it is important. I was very happy to see U.S. Treasury Secretary Janet Yellen's recent calls to resurrect the Marshall Plan to help countries in need transition out of poverty to clean energy. This could be the source of the next black swan. And it's understandable we've all been stressed given by all the geopolitical risks and tensions. But please, let's not forget the incredible abundance we've managed to accumulate relative to others. And let's keep an eye on this new potential Marshall Plan, where it leads. And I personally plan to support it. Oops, sorry about that. Thank you so much. We may have time for at least one more question. No time, shoot. Well, please, you have our contact information, which we put on the slides. Feel free, we're all very, very approachable and impassioned about the topics we talked about today. Again, thank you.
All right. Thank you again, panelists, for that engaging discussion.